You are listening to Keystone Stock Talk Show, episode 319. It's great to chat with you again this week. I kick off the show by revisiting a review on Descartes Systems Group, Inc., symbol DSG on the TSX, a software as a service, logistics and supply chain management solutions for distribution-sensitive industries. The stock had a great 2024, but has dropped 30% over the past year. In our last review, we called it pricey. I'll let you know if the recent haircut provides a buying opportunity. Brennan replies to a viewer query on ATS Corporation, symbol ATS on the TSX, an automation and technology leader. Brennan lets you know if this growth by acquisition business is delivering the per share growth needed to drive a stock such as this higher long term. Brett answers a viewer question on Nexliving Communities, symbol NXLV on the TSX Venture, and owner and operator of multifamily residential properties. The non-REIT owns 2,073 units across New Brunswick, Quebec, Ontario, and Manitoba. It is focused on high-growth Canadian secondary markets. Brett lets you know if this small cap offers value. All right, let's get to the show. I welcome my hosts, the Killer Bees, Brett and Brennan. How you guys doing?
Doing good.
Doing well.
Good. Excellent. Are you excited to be kicking off our final webinar of the year? We sold out the November 27th, and there are limited tickets available for this Tuesday. That's Tuesday, December 2nd at 7 p.m. Eastern. That's 4 p.m. Pacific. It's called What Stocks to Buy for an Uncertain 2026, talking about AI. The mega caps do a full review on the technology, those technology 7, telling you what to buy, sell, and hold in the sector. We'll do a bank review based off our bank review we did just this past month, all the Canadian banks and some ancillary financial companies in Canada. Brennan is going to talk about the budget, Carney's budget, see if there's any opportunities there. He's also going to review the price of gold surging and the four drillers in Canada, comparing those against each other. So if you want to build a better portfolio, get to that. All right. Again, that gets it out of the way. Let's get into the show. Anything you guys want to talk about? Anything interesting this weekend?
I think you had something interesting this weekend. I didn't do much. I went to the golf.
What did I do?
Didn't really do
I
much.
went to Costco, you mean? Is that what you're talking about?
Well, you went to
That was
the
thrilling.
Harry Potter. You went to the Harry Potter thing.
I went to Harry Potter Forbidden Forest in Stanley Park in Vancouver. Very cool. Maybe I'll send a picture because everybody wants to know. But it actually was. We were there for like 3 hours. Went through. I produced a full Patronus, which I can do at home, but I did that in the park this time, of course. So yeah, it was pretty cool. It was, my 10-year-old daughter just is into Harry Potter just as much as me. So it's good. It's cool.
Yeah, it would have been fun. Looked fun, at least from the pictures.
It was good. And we blew up a blast end scroot, Brennan, which I know you know what that is.
Of course.
All right, I'm moving on. We did have wizard stew and chicken pot pie, so that was cool. Yeah, it was good times. All right, get your tickets for the webinar. Let's move on. We don't have a poll this week. We'll make sure to have one next week. There's nothing else. You guys did nothing.
We did nothing. We're focused on the webinars. And if you do, since we will be posting the podcast pretty much right before we go live, if you're catching it live, get in the webinar right then. But we do also have on demand after the fact if you're a bit late.
Awesome. Well, I'm just going to get right into the show. I'm going to review a company that I actually reviewed this time last year. The company that I'm going to review, it's a high-quality Canadian software company. We monitor it, but have yet to buy. That company is Descartes Systems Group, symbol DSG on the TSX. We reviewed it about a year ago to this day when it traded back at $170. In the review, I stated that we liked the business, but valuations were high. In fact, we noted that the stock was priced to perfection. Descartes traded at about 75 times trailing EPS, around 49 times fiscal year 2025 expected free cash flow, which was near all-time highs. Stated at the time, any hiccup in growth could fell the stock. Well, the stock has now been falling. It's down about 30% over the past year to $114.95. We I'm going to review the current valuations and see whether the 30% drop it provides an opportunity to buy. But let's look at Descartes first. Like I said, trades at 114, $9.8 billion market cap, no yield, doesn't pay a dividend. It was founded in 1981. And it's based in Waterloo, Ontario. They are a software as a service company, logistics and supply chain management solutions for distribution sensitive industries all around the world. The company operates a transaction network called the Descartes Global Logistics Network, which provides electronic document exchange across various transportation modes and between enterprises. Descartes Global Logistics Network has over 200,000 connected parties in more than 160 countries and performs around 20 billion transactions per year. In addition to Descartes Transaction Network, the company provides value-added applications on top of its transaction network for 5 segments of the market: mobile and telematics, transportation management, customs and regulatory compliance, forwarder and broker enterprise solutions, and trade content. All right, let's look at this stock over the past year. Like I said, down almost 30% after posting a gain of nearly 47% in 2024. So let's take a look at the recent results from this company. We expect earnings out over the next week for Q3 fiscal year 2026, but these are the Q2 fiscal year 2026 highlights. Revenues was up around 10% to 179 million in the second quarter, up 7% from the previous quarter. Decent growth, but down from about the 15 to 17% growth range in the previous year. And the growth is basically all from acquisitions. Or organic growth or like-to-like growth was minimal. I'll touch on that in a minute. Income from operations was about 48.2 million, up 5%. Net income was up around 10% to 38 million. Net income as a percentage of revenue was basically consistent with the same period last year at around 21%. EPS, or earnings per share, was up 7% to 43 cents per share from 40 in the same period last year. And adjusted EBITDA was up 14%. As a percentage of revenue, it was a little bit higher, 45% compared to 43% in the same period last year. Company continues to have a strong balance sheet, about 240 million in cash. Cash increased about 64.2 million in Q2 fiscal year 2026 and increased by about 4.5 million if you look in the first half of fiscal year 2026. There's no real long-term debt in the business. Let's look at some M&A activity because that is important to this company. They acquired Package Route, a leading provider of final mile carrier solutions. The purchase price was approximately 1.9 million net of cash acquired, funded from cash on hand. This is a small acquisition for Descartes. A little more substantial acquisition was completed on August 1st. They acquired Final, a US-based provider of cloud-based inventory management solutions designed to support e-commerce businesses across their growth lifecycle. The purchase price was approximately 40 million net of cash acquired, which was funded from cash on hand, plus potential performance-based contingency consideration of up to 15 million based on the company achieving revenue-based targets over the first 2 years post-acquisition. So again, that's the price right there. Now let's look at the Q3 outlook and forecasts. Acquisitions are expected to drive the majority of revenue. Recent contributions, about 14.3 million in Q3. Those came from recent acquisitions. Acquisitions account for roughly 85% of the year-to-date revenue growth or year-over-year revenue growth. Q3 includes the first quarter of contribution from Final inventory. Estimates about 2.5 million, which Descartes acquired on August 4th, like we said, for 40 million. Finale inventory it's Descartes' fifth acquisition over the last 12 months and brings their trailing 12 months capital deployed to about 291 million. That's nearly double the prior 12-month period. So we expect baseline call to increase headline organic growth. So we would say that headline organic growth is expected to increase in Q4. They may provide Q4 baseline. They're forecasting out there right now of 159 million and 62 million of adjusted EBITDA. That would be revenue first, adjusted EBITDA second, which implies that there's about 12% year over year growth and about in revenues and 12% growth in terms of EBITDA. Now, if we look here, largely this is due to easier comps, harder headwind in Q2 and Q3 of the previous year. There's about maybe 2 to 3% organic growth in that quarter. Let's look at the valuations here. It trades at about 60 times PE on a 2026 forward basis. If we go to 2027, it's about 45.5. And if we look on an EV to EBITDA basis, it's about 21.7. So these valuations have come down considerably from when we reviewed it last year, but they're still not cheap given the lack of organic growth. If that organic growth can return to 5% or go above that rate, it starts to look a little more attractive. It's a high quality, in conclusion here, SaaS business with a solid balance sheet and a strong track record of compounding capital, both organically and inorganically. We'd like to see organic pick up. Long term, we believe the company can continue to create shareholder value through smart, accretive acquisitions. Organic growth, if it goes to the high single digit level, that would be above historicals, and margin expansion could result from free cash flow growth. That would be nice to see in the business and would allow us to potentially look at buying the company. It's a defensible long-term holding, but the forward stock valuations still are relatively high and in a pricey overall market. We like the business long-term. Again, we see it pricey. We'd like to see about a 15% pullback in the stock. This is a capital compounding stock. They have deployed roughly 1.7 billion on about 53 acquisitions since 2009. We expect them to continue to acquire over the course of the next year. Again, like I said, we'd like to see a 15% pullback before we entered the stock or considered entering the stock. It's not priced to perfection now, but it's still pricey given the pullback in organic growth and the acquisition growth that is just, the 10 to 12% range. We'd like to see a combined level of between 15 and 20 before it got us a little more interested. And those are disclosures there. We do not own anything in the stock right now.
Yeah, interesting that they've been picking up the pace of deploying capital there that you were showing. But I mean, when you have that kind of balance sheet, you're able to do so.
They generate good free cash flow. They can compound it. That's what they want to do. If you can combine like 5% plus organic growth with compounding and getting it to that 15 to 20% year over year, then it starts to become more attractive.
Yeah, it's always a concern when you see these M&A companies, they start to go further and further into net debt, which obviously Descartes is on the other side where you do still have that cash position, which is helpful in these scenarios. So if they're not the only one seeing decreased valuations in their market, then they can actually be opportunistic to deploy some cash in that environment.
And sometimes the larger you get, the harder it is to continue to grow. I mean, they're generating good free cash flow. The one acquisition they made in quarter there looks to be, a little more creative. It's a larger acquisition. The smaller one it's basically tiny for this company. I mean, they used to be able to make an acquisition like that and it would make, a little bit of a difference. That is just really buying the tech there. It looks like more than actually buying revenue. So interesting business, done well, capital compounding over time. If they can continue to generate free cash flow and recycle that, I'm sure that they wouldn't mind a huge sell-off in the tech sector to start deploying some of that capital. I mean, there are some companies we follow that have really strong cash positions that, have had to pay multiples. They're probably, squeezing their fists a little bit and saying, I don't want to pay these multiples, but we have to grow. It's management's job then to be disciplined. If they could see a pullback in valuations, then, they can make more acquisitions at more reasonable prices, and then it's more accretive. that would be actually probably a positive for this company. It might hit the stock because you'd see they are a software company as well. They'd probably have a squeeze on their valuations, but they could then deploy that capital on a more accretive basis at some cheaper prices. All right, let's move on. Brennan, you are looking at, what are you looking at this week?
I'm looking at ATS Corporation. So yeah, it's kind of a nice segue, even just from what Brett was saying, where a lot of the times we see these serial acquirers just kind of growing their net debt and their net debt to EBITDA multiple. And here is one of those. So I will share my screen.
Was it not at one point net cash when we looked at this, right?
Yeah. So I believe so.
You thought so. You're not gonna commit to it.
No, I'm not committing.
Brennan has a fear of commitment. That's what we're getting out of this.
True that. Okay, so yeah, we had a question come in a few days ago on ATS Corporation, and Luke says, "Hi guys, how about an update on ATS? They have had an interesting year. Thanks." So let's get right into it. ATS Corporation, ATS on the TSX, currently trading at a price of about $35.78, about a $3.5 billion market cap. And they are a global automation and technology leader that designs, builds, and services custom design manufacturing and assembly automation systems for a wide range of multinational companies in markets such as life sciences, transportation, food and beverage, consumer products, and energy. Over the past 12 months, 55% of revenue came from the life sciences market, 17% from food and beverage, 15% from consumer products, 8% from transportation, and 5% from energy. And over half of revenue is coming from North America. And looking at revenue by type in fiscal year 2025, 37% came from custom integration, 30% came from products and equipment, and 33% came from services, including spares. Now, the company has been a serial acquirer over the years, deploying approximately $1.8 billion of capital since 2018 through 23 acquisitions. So, it's quite the stark contrast where, Ryan was looking at Descartes, deploying $1.9 billion since 2009, I believe the slide showed. So, and across 50 acquisitions. So, they've been very, very aggressive acquirers here. And the last acquisition, which the company made, was in September of 2024 of Heidolf for 30 million euros, in the life sciences market. So they've really been focusing in the life sciences, as you can see on this slide. And as you'll see in my upcoming slides, the company has been primarily funding these acquisitions through debt. So we've covered the company a few times on the podcast and have written monitor reports for our clients. I wrote a monitor report back in November of 2022 at a price of about $45 per share, but it was really relatively pricey in my opinion, while it was trading at about 30 times earnings and 14 times enterprise value to EBITDA. The last time that we discussed the stock on the podcast was back in October of 2023 when Ryan covered the company. And the share price has almost been cut in half since its 2023 highs. But let's kind of see what the headwinds are and where the company is today. So looking at the last quarter, Q2 2026, ended September 28th, 2025. Revenues increased 18.9% year over year to $728.5 million. Organic revenue growth was 12.6%, which is strong, alongside a 3.9% positive impact for foreign exchange and 2.4% growth from acquisitions. Net income was $33.6 million or 34 cents per share, compared to a net loss of about $900,000 or 1 cent per share a year ago. Adjusted EBITDA was up 32% to $103.7 million. Adjusted EPS increased about 80% to 45 cents per share, compared to 25 cents a year ago. Now, order bookings, they remain pretty strong, $734 million in the quarter compared to $742 million a year ago. And order backlog is robust. 2.07 billion, 13.5% higher compared to 1.8 billion a year ago. And looking at the valuation, looking at trailing accounting earnings, they are negative, but the business trades with a trailing price to adjusted earnings multiple of about 22 times, a trailing enterprise value to adjusted EBITDA multiple of about 12 times, and a trailing price to cash flow multiple of about 12 times. So I would say that the valuations are certainly getting more attractive, than when we've covered it last and when I wrote that monitor report. But keep in mind, it is a capital intensive business with EBITDA margins in the 14% range, and organic growth in the high single digits. Now, looking at the balance sheet, I believe the debt is sustainable, but it's currently at the higher end of my comfortable range, really, at 3.1 times trailing net debt to EBITDA. Management's target is to get it back between its target range of 2 to 3 times by fiscal year 2026 end. And again, we can see that here on this slide. This is from their investor presentation. The business really aggressively levered up, making acquisitions over time, and the company has been pretty good at not diluting shareholders overall, primarily using debt to fund the company, to fund its acquisitions. But looking at the end of fiscal year 2023, they did issue some shares, raising about US $289 million. Now, moving to the outlook, backlog, again, I did say this before, but it was up 13.5% year over year, led primarily by energy and consumer products, but was offset slightly by the decline in transportation due to headwinds facing the EV rollout. We have seen that be a lot softer than originally expected. The business is guiding Q3 2026 revenue of 700 to 740 million in revenue, which is growth of about 10% over fiscal year 2025 at the midpoint. It's Q3 fiscal year 2025 at the midpoint. And management has indicated that they're looking for organic growth in the high single digit range for the year, which, considering they did 12% in the last quarter, pretty good. They're definitely on track. The business is also looking to restructure to help margins, anticipating total restructuring expenses of approximately 15 million through the rest of the year. So this is something to keep in mind in future quarters. So to conclude here, ATS is positioning itself to be a significant player in the automation industry and focusing on several intriguing verticals. Revenue growth has slowed in fiscal year 2025 due to a concentration in the transportation segment contraction in the transportation segment related to EV projects, but backlog growth is robust due to other verticals. Now, as I've mentioned, the debt leverage is high and above management's targets. The cadence of acquisitions also does appear to have slowed. They didn't complete any acquisitions in calendar year 2025. The other years, previous years, we had seen them make an acquisition basically every single year. So that is something to note. And really the question is this, growth at a reasonable price? It's trading at about 22 times earnings or adjusted earnings, and an EV to EBITDA of about 12 times, with organic growth of about 6 to 9%. That's what they're targeting. I do think that it's intriguing, but I'd really like to see them kind of get that debt under control. Even like when Ryan was going over Descartes, or Descartes, who I'm sure Ryan's going to butcher me afterwards for saying that wrong. But just seeing them, they've been able to maintain such a beautiful balance sheet, and maintain a great balance sheet and deploy capital on acquisitions along the way. I'd really like to see ATS Corp focus on organic growth, supplement organic growth with a few acquisitions here or there, really pay down that debt. So that's really what I would like to see the business do. Other things to note: the second half of fiscal year 2026 may have some easier comparable quarters to stack up against in fiscal year 2025. But again, we will see some restructuring costs coming in the next few quarters, so keep an eye for that. Now, on tariffs, I didn't really mention much about tariffs, but a majority of the company's shipments from Canada to the US do fall under the USMCA. So that is good. And again, I do like the business. It looks a lot better than when I wrote up, a monitor report for clients a few years ago. But I just like them to get their debt under control. We'll see how they can do that over the year here, and continue to, focus on that organic growth. And that is it. That is all.
Descartes. I think that's what I probably said it wrong the first time.
No,
but I think it's
no,
Descartes.
I do think
I think
you're
it's
right.
it's isn't a French philosopher or
should,
something like that
yeah,
it's based off of or something. Yeah.
I shouldn't even have said Ryan would butcher me for that. I should have said my French girlfriend would butcher me for saying
there
it
you
wrong.
go. That's
yeah,
and rightfully so. You need to
Yes.
go home and show her what you did and
Oh, and here is the
disclosure
as well.
Good idea.
Sorry, didn't get there.
Yeah, for sure. I mean, it again, it's an interesting company. It's something that we we watch these companies try to grow by acquisition.
But yeah, the other thing interesting about ATS is really them being, even though it's not the biggest segment, is the nuclear part of their backlog. It has grown so substantially over the past year. It's 109 million versus 277 now, so massive. And we've just been seeing such a buzz with nuclear becoming a trend, with AI build out being a potential source, all like the mini reactors and so on, and just general interest in nuclear. So even though it is a small part of their overall business, it could be an interesting portion of it. It could provide some tailwinds for the company.
Yeah, and what it does, it could provide a higher multiple if people associate it with that, and then there's excitement regarding nuclear. Then yeah, it could provide that. But we have seen just with these generally with the growth by acquisition stories, you have to be careful with your debt. You get these companies get excited to keep a growth rate at a certain level, and you see they're mounting debt levels to get it up to keep the growth rate at say 15% or above 15% every year. And if you just are going into too much debt to do that, and you start to get to a point where your debt to EBITDA levels are significantly high, then you have to stop that. And then suddenly the market says, but we want you to grow at 15% still. And then they can't. And now we're deleveraging, and then it can get into a vicious cycle. I'm not saying that is what is happening to ATS Corporation, but we've seen it happen many times in the past. So it's nice to see companies that, if they go into debt because you don't want to dilute, maybe they pay off that debt over time and do it a little more measured instead of trying to do it all at once. And that's
exactly
often what we see.
And that's the thing. Like, I'd really like to just see them kind of make more of a measured approach. Because again, when all of a sudden you're tapping up to, where the management is even comfortable, with their debt. Now all of a sudden we haven't seen any acquisitions, which is fine. It's totally fine.
But I mean, that's the share price is flat or down over the past year, isn't it?
Yeah.
And that's the market's like, where's your growth? So
yes.
I mean, I'll juxtapose that with a company that we recommended earlier this year that is a boring U.S. manufacturing business that basically goes into debt, but then pays it off, goes into debt, then pays it off, or they pay off their acquisitions out of cash flow. And so you never see a share price increase, and you never get to the levels where at any point you're worried about them servicing their debt. And, instead of having a down year, that stock is up 80% this year, right? Crawford United. And we talked about it before, but it's a company, boring U.S. manufacturing consolidator. But you see the share price jump over the course of this year, and that is because they made a good acquisition. By the end of this year, they'll probably have it paid off and start to be in net cash again and make another acquisition. But they don't need to make 10 acquisitions in a year. They're sustaining a growth rate that is a reasonable to significant growth rate with that acquisition they made, but doing it more responsibly and measured. And it's kind of the tortoise and the hare. Sometimes you see that, and everybody wants the short-term growth, but like the steady growth tends to be where you want to invest in over time. It'd be great to have amazing growth and a reasonable balance sheet, or a cash-rich balance sheet. Once in a while, we see that as well because it's all organic. But I mean, that's the best type of scenario. But if you're going to do growth by acquisition, it's a tight wire you have to walk. You have to do it responsibly, rather see it done over the long term versus trying to do it all at once. All right. Let's close off with Brett. He's taken a viewer question on, and you're going to tell me.
Nexliving.
There we go.
Yeah.
I knew that.
Yeah, so Nexliving Community, symbol NXLV on the TSX Venture. It's an owner and operator of a multi-family residential properties. They own 2,073 units across New Brunswick, Quebec, Ontario, and Manitoba. Manitoba, I can't even speak right now. They focus on high-growth Canadian secondary markets. I will note they are a corporate entity, not a REIT. That does cause some differences between REITs, but they really do have the same market factors coming into them. The share price, while rising 11% year over the last year to $2.40, has been quite volatile, as you can see, dropping as low as $1.55. The company currently has a market cap of $78.4 million, which is quite small for anything to do with real estate. You do normally want that scale. And just a longer term view, we can see the shares have not really had a great performance for the past years. Let's look at where they are now and potentially what's in store for Nexliving. Well, just over a year ago, I want to highlight the DevCore merger. Even though it says a transaction here, it's funny on the DevCore site, they call it a merger versus an acquisition. But they added 991 units across 16 properties, which effectively doubled the unit count with expectations of a 30% FFO per share growth. Nexliving assumed $165 million in mortgages, issued 16.3 million shares to DevCore, making them just under that 50% threshold of outstanding shares. The board had 4 new directors added as part of the agreement. So while not an absolute controlling majority, DevCore is the biggest block shareholder and has significant influence over the company. So you do need to take that into consideration. Looking at a key differentiating factor for Nexliving is they operate in secondary markets. So Moncton, St. John, Gatineau, Cornwall, not the focus on primary markets like Vancouver or Toronto or even Calgary, which you see in many of the public real estate investments, primarily REITs, which does shift the region risk profile, which can materially affect the company for better or worse compared to other real estate vehicles. If we see the collapse in the Vancouver real estate market, obviously that doesn't affect Nexliving. But if you see a boom and other REITs or real estate investments have exposure to it, they benefit where Nexliving wouldn't. As well, as you can see there, very different home prices, rent, cap rate, unemployment, all that factors into how you need to perceive these companies, because it is, while very broadly macroeconomics impact them in a similar fashion, the regional diversification or lack thereof does matter quite a bit. Further, the company focuses on young assets. 83% of their suites are less than 15 years old, which further results in lower expected capital expenditures for maintenance. But that does increase the dependence on rent growth, or appreciation of the actual real estate, as you can't do these value-added capitals, which you'll commonly see some of the more mature REITs they'll look for a property 20, 30 years old, hasn't been renovated, they renovate it, then they get a big jump in their rent. So now looking at the most recent quarter, Q3 2025, occupancy did decrease 30 basis points quarter over quarter as regular turnover occurred. Quebec improved by 20 basis points. New Brunswick and Ontario decreased by 60 and 70 basis points respectively. No massive quarterly shifts, but tiny decrease. Net operating income, or NOI, increased by 51.9% to $5.3 million, with NOI margin having a 100 basis point improvement to 61.7%. Same property revenue increased by 3.1% to $4.5 million, with same property NOI increasing 4.5% to $2.7 million, as revenue growth did outpace expense growth, which the expense growth was at 1.1%. This is in part due to the internalization of the property management in St. John. FFO per share grew by 29.5%, which is great, to 6.7 cents from 5.2 cents, which is a record level and is generally just a strong level of FFO per share growth, which you want to see. But the trailing 12 months has not been so great, which I'll show in a couple of slides. The company does have a dividend and a yield of 1.7% and a payout ratio of 15% for the last quarter, which is lower than REITs. But this is a company is set up to benefit from share price appreciation and recapitalizing recycling its capital over again, instead of having distributions. That's where your shareholder return is going to be, is through the share price, not through distributions. If you are looking for an income play, Nexliving isn't. You'd want to look for a restructure. Further, the debt levels for Nexliving are structurally higher than REITs, which are normally in the mid-30s, to 50% net debt to gross book value range for REITs, residential REITs that is, whereas Nexliving is at 68.2%. It can take on higher debt due to being a corporate form, allowing for higher capital flexibility. That lower payout ratio does help with debt servicing, but this does increase the sensitivity of the company to refinancing. No more debt is due for the rest of 2025, but 47.6 million is up for refinancing next year, and it is at a lower rate of 2.37%, below the company's average of 3.11%. And barring any significant interest rate drops, the renewal rates will likely be quite a bit higher, with market rates being in the mid to high 3% range, depending on the term. The most recent Nexliving refinance I can see was on May 20th at 3.45%, so well over a percent higher, or quite a percent higher, about, no, I shouldn't say well over, 1.08% higher than what they would be replacing on average. So obviously, interest rate matters. As you can see there, I've highlighted at the bottom, 100-point basis increase in interest rates would increase net interest expense by $3.2 million. The company trades at a price to FFO of 11.7 times, which is a discount to most residential REITs. But a discount to REITs, just due to the structure, is inherent, as they do pay taxes. They are not shielded, and that's why REITs have to pay that higher distribution. Further, the company is smaller, has lower access to capital markets, which matters a lot more for real estate than many other types of companies, as you do want to normally raise, it's high capital intensity. So you do commonly need to raise money, whether it's through debt or equity markets or units in the case of REITs. So it will just have a intrinsic discount due to the size at this time, which is why the merger really can actually help them up, just because they do get that scale to them. Overall, the company is interesting and has positioned itself in different markets than many other real estate plays, with a focus on newer properties. But this does have risk with higher interest rate sensitivity due to debt levels, as well as growth within the selected markets and the regional factors. No significant value add renovations really can be done on those new properties, and they will need to then further recycle the capital over time, as if they are looking to hold that sub 15 once it's 15 years old. You have to recycle the capital, sell, which would be at a higher cap rate or lower valuation, unless you have a appreciation across the market. The company does trade a discount to Canadian REITs due to the size, leverage, and corporate structure, but I would say this is a fair discount at this time. This is a growth play compared to an income play like REITs, but it's still impacted by similar market shifts, so you do still have the standard risk to do with REITs as a whole, so all your real estate risk, interest rates, market dynamics, and all that. But we will continue to monitor this stock at this time. And just for disclosure, we do not have a position in Nexliving.
Yeah, I think it's a good review. We've interviewed management. I think they're competent, and yeah, I think Brett outlined the story well there. And again, we're not looking at it as if you're buying this like you might buy a typical REIT where you're having a dividend be a strong part of the return. You need growth in this business. That's and where it needs to come from. And they have had FFO growth over time. If that continues, then you can continue to see growth. We'll keep monitoring it. Brennan, any additions or?
No, I think that's good. Yeah, I mean, I thought that the interview with Stavro, the CEO, was pretty good. It was interesting.
Yeah.
Yeah, overall.
Good. Okay. Well, that is going to conclude our show for this week. Keep your questions coming in for our Your Stock, Our Take segment, and we will continue to endeavor to answer those on a weekly basis. If you can, and you've got this watching it right now, and this is on a Tuesday, you can get those tickets for the December 2nd live webinar. I think there will be an on-demand version if you're listening to this later, but get those tickets, as it is our last live webinar of 2025. If you're watching this on YouTube, smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.